Major breakouts in gold have often served as an early warning for serious economic trouble, and gold price spikes have generally signaled two different types of economic trouble. One of them is economic stagnation. That's what we saw in 2007. That year, gold broke out to new all-time highs, rising more than 50% in just over 6 months. And sure enough, trouble was on the horizon. The gold rally was followed just months later by the Great Recession. Unemployment peaked at 10%, and the stock market collapsed, falling 57% in under a year. And that's not the only time gold sent a signal like this. We saw something very similar in 1980. Gold prices surged, doubling in under 2 months. That was soon followed by the 1980 recession. Unemployment rose to nearly 8%. The stock market fell 17%. Both these instances, 1980 and 2007, remind us that gold rallies like we're seeing today suggest that investors are concerned that economic difficulty could be on the horizon. Of course, that's not guaranteed, but recession isn't the only thing gold price spikes might signal. Historically, they've also pointed to inflation on the horizon, and the 1970s provide multiple examples of this. From 1970 to 1972, gold prices nearly doubled, right before a destructive wave of inflation sent the core CPI to 12%. And the same thing happened again in 1977, when a 70% rise in gold prices preceded a second big wave of inflation that decade. The CPI rose to nearly 15%. Now, the question is whether the recent gold price spike indicates a recession or wave of inflation on the horizon, or if something is different this time. To find out, we need to look at why gold price spikes have historically so often signaled economic turmoil ahead, and this chart helps explain it. Here we have gold prices in black and real interest rates in blue. Real interest rates are the true return on cash holdings, how much your money grows or shrinks after subtracting inflation. Notice how gold prices often move in the opposite direction from real rates? This is especially clear during the 2010s, and that inverse relationship is the key here. When real rates are high, investors prefer holding interest-bearing debt like treasury bonds instead of a store of value like gold. But when real rates are low or negative, that debt can't keep up with inflation. That's when investors flock to gold.